Well, I'll go ahead while we're getting the slides to appear. There we go. Great. As Caprice mentioned, we are a business software solutions provider in business software categories commonly known as ERP or related products and services. We have a focus on technology company, and we have a product suite that focuses on revenue billing, business model support for people who have software companies or people who have software compliance or revenue recognition compliance type requirements. And so the software category tends to be fairly broad in terms of revenue recognition and incorporates other types of companies like service providers or IP providers and so on. The types of things that we're supporting really fall into three general functional areas. One of them is the revenue management functionality. One of them is billing support for certain types of business models that require business model or billing support and contractual management support. And the third one is really just understanding your business model, your transaction flow, and how the data gets to the revenue management. And we'll talk just a little bit about that. In terms of the general category things, we find that most people's needs and issues and pains fall into three general categories. Visibility for the revenue and the transactions and the customer history, productivity, or how to keep your lean team as efficient as possible so that they're focusing on analysis instead of lots of manual transaction management, and then compliance or regulatory compliance, as we're going to talk about today. If we could forward the slide, please. I think it's helpful just in terms of talking about names and companies and so on that we have worked with, a good bit over 125 tech companies at this point, and sometimes it's helpful just to throw up some names or some company logos and so on to give people a feel for the types of the breadth of the industry. It looks like the slide hasn't fully loaded, and so we may need to do a little more of a build there. I think you'll recognize there are names on here that are public and private companies, people that are emerging and established players, people that sell hardware devices with embedded software and pure software, people that sell OEM models and subscription models, people that do high volume, low cost transactions, and people that do fewer transactions and very high dollar. So a real mix of things, just like the tech industry itself. Next slide, please. So we'll just look at two things, and then we'll turn it over to Jeffrey. This is a little bit more on the business model support, because I think that's an important for people to understand that the systems need to match how your company does business. And so the first thing is really for revenue recognition, as we go into the regulatory compliance discussion today, is how is the sales transaction generated? And that's really the go-to-market model or the business model that each company has. So there is a process or maybe multiple processes for how your company creates the transaction. It can be from your website, from your ERP system, from our contract or complex customer agreement management. And once transactions are created, you need to have a policy that is determined ahead of time and then automatically applied to the transactions. And so we do this by a different types of documents to allow you to have different compliance models within one company. And for a transaction-based, certainly the SOP 972 EITF 0801 methodologies for determining the revenue base and then applying the revenue rules to that. If we could go to the next slide, please, that would graphically illustrate the same concept. So this is the same type of concept, and starting from the left, going to the right, we have the sales transaction creation. And so if you think about people that sell a software as a service or people that sell a subscription-based model, your website, or you may have some CRM system that creates your transactions. If you have a complex customer agreement, where you're managing multiple elements and parts and so on. We do have a contract administration suite for that. And we've also done things to integrate to ERP systems to pull the data straight from an ERP if you have a shipment of a product that's going to a customer. These sales transactions are created and put into the pool where revenue methods are applied and determined, the document flow is determined, the determination or base valuation is determined, and this determines your revenue subledger, your revenue recognition that heads to your ERP, and your reporting and analysis. And so this is a general flow of the types of things that we do. And certainly we're pleased to be sponsoring Jeffrey today and working with him. And there's a lot of compatibility between the types of consulting and expertise that he has and the types of software that we seek to deliver to our customers. Next slide, please. So it's my pleasure to introduce Jeffrey. Tensoft is committed to providing revenue and contract management software to customers. We understand that software is only part of the total solution. Another element of managing revenue recognition is really understanding the determination, the application, and the recognition of revenue. With that in mind, we're working with thought leaders in the area to provide relevant information and resources to our customers. And we have a good partnership with Jeffrey Werner. Jeffrey Werner is an acknowledged expert in the area of software revenue recognition. He's been providing revenue recognition consulting services to software and high-tech companies since 2001. And prior to launching his consulting business, Jeffrey was a CFO of Antrim Design Systems, a mixed signal synthesis company based here in Silicon Valley. Before that, he was VP of Finance for Telepost, a web-based communication services company based in Santa Cruz. And earlier in his career, Jeffrey spent 11 years with KPMG Silicon Valley office where he was a senior manager. He really has a broad set of experience, both as the type of person who is responsible for delivery of that information to all the constituencies in a company, as well as advising other companies. Jeffrey regularly teaches software revenue recognition classes in the San Francisco Bay Area. He has over 15 years of experience helping companies comply with revenue recognition policies. And Jeffrey is available for revenue recognition consulting, EITF 0801 implementation and compliance support. And we've been really pleased and have seen the great response that he gets from consulting customers on both the value of what he delivers and the way that he delivers it. So, Jeffrey, the floor is all yours.
Thank you, Bob, and welcome everyone to today's webcast. We'll be discussing software as a service. So this is our outline for our webcast today, the introduction, which we've just participated in, and a couple more items. We'll talk about the SaaS business model, review the 4 revenue recognition principles. Then we'll talk about SaaS accounting, when SaaS is treated as software and when it's treated as a service, and some other related topics, setup fees, related costs, consulting and trading services, and fees based on usage. So just another introduction myself. I do a variety of revenue recognition services, including contract review and consulting, VSOE studies, training courses, and recently we've been working on a lot of EITF 08-1 implementations. There's quite a bit of interest in that topic. I also want to mention an upcoming event on Thursday, May the 19th and Wednesday, May the 25th. There'll be 2 half-day webcasts on software revenue recognition. It's sort of a software revenue recognition 101. There's CPE credit for that. It's a pay-per attendance event, and registration and details will follow soon. Here's a brief outline of what we're doing. Revenue recognition principles. We'll talk about multiple element arrangements, VSOE, license support and services issues in day 1. In day 2, we'll review the items that we talked about in the previous session on the 19th. We'll talk about services contract accounting, software as a service, a little more in depth than we're covering today, the new EITF 08-1 and 09-3, and also a look at the future with the FASB IASB revenue recognition project. Again, if you're having any questions during the course of the webcast, you're welcome to present them in the question tab. Any questions we don't get to during the webcast today, you can also email them to me. I will respond directly to you, and also we'll be posting the questions and the responses on the Tensoft blog. The recording and the slides will be available at the Tensoft Resource Center in about 24 hours. So now let's begin with the SaaS business model. If we think back to the way software industry has evolved over time, back in the mainframe era, a lot of companies accessed computing software via a timeshare model. Then we had perpetual licensing with the mini and the PC era. We had items such as license fees, support fees, implementation fees, and it had a high cost of ownership. The costs tended to come up front. There was a long time to implement, and customization was required. Over time, term licensing also became one of the software licensing models in the EDA industry. We use this quite a bit, spread the cost over the periods of use. Then we moved into software as a service with the evolution of the internet 10 or so years ago. It became a question of whether a company wanted to have a service or they wanted to own the software. And Salesforce.com was a real leader in this area, made SaaS acceptable to a lot of customers. And before we move into some of the benefits and drawbacks of SaaS as a service, software as a service SaaS, we'd like to do our first polling question for those of you that are interested in CPE credit. So Caprice, if you could pop that up, and we'll get the polling question going. So I'm not seeing that. Has the question come up?
Yes, the polling question is out there.
Okay, could you read it? Because I'm not seeing those.
Oh, all right. The question is, does your company have multiple element SaaS arrangements? Yes, no, or not applicable. And we do have, let's see, looks like 84% of the folks have voted. I'll give it another few seconds, Jeffrey, and then I'll close the polls.
Okay.
Just a reminder that if you do want CPE credit, you must answer all the polling questions. So,
okay, so we'll move forward then with software as a service. Some of the customer advantages are it's easy to implement, it's ready to go, it's a standard setup. There's typically low upfront cost, and the cost is incurred over time. You pay as you go. There's lower internal IT costs because the vendor keeps the software running, and there's less administration of licenses. You don't know how many to buy. You don't get licenses lost on computers that are no longer used. Updates are automatic so that you don't have to go out and find each individual computer and update it. It's an easy access over the internet browser interface for any computer that has internet access, and it's network-based rather than PC-based. Some of the vendor advantages are it can be potentially easier sales since there's lower upfront costs and there's lower cost of ownership. It's a predictable and ratable revenue model for the vendor. It's easy to upgrade and change features and to keep all your customers on the same version so you don't have multiple software versions to maintain. And your customers are locked into usage. It can be hard to change to another vendor once you get in there, and it's ease of use. Some of the disadvantages from the customer perspective, and this was particularly true at the onset of SaaS, mission-critical resources in the control of an outside vendor. Your data is at the vendor, so there's privacy concerns, and uptime's dependent on the vendor and the internet. From a vendor perspective, there's no one-time large revenue hits from large customer sales. And you really need to have a customer focus to provide that service to your customers in a really high capacity, or you can lose your customers. We'll take a look at the general principles of revenue recognition. They apply to SaaS as they do to all revenue transactions. And the first one is that persuasive evidence of an arrangement exists, so there needs to be a contract of some kind, an agreement between the customer and the vendor. Delivery has to have occurred, so that typically occurs over time in a SaaS arrangement on a monthly, weekly, or annual basis. The fee needs to be fixed and determinable so we know how much revenue to account for, and collectability needs to be probable. So we need to meet all four of these criteria in addition to the various specific policies and practices that we'll talk about later in the webcast. And there's just an easy mnemonic device that I like to keep handy in software or in revenue recognition. It's not ABC, it's C, D, E, F. C is the collection, D is the delivery, E is the evidence, and F is the fixed and determinable fee. A little slightly different order than we presented them, and you normally hear of them, but if you're having trouble remembering what one of the items is, if you've got the four fingers in the C, D, E, F, you can keep that easily in mind. Some of the accounting literature that we refer to and that we access in SaaS revenue recognition accounting, of course, statement of operating SOP 97-2 and 98-9 software revenue recognition statements of position. SEC staff accounting bulletins 101 and 104. The various TPAs or technical practice aids from the AICPA. The EITFs 00-3, 021, 03-5, and the recent EITFs, which are now required starting in 2011 for calendar year companies, EITF 08-1 and 09-3. Of course, all of these except the SABs are now under the new FASB codification with their new codification numbering and referencing systems, but I find that most people still refer to them by the old numerical and pronouncement that they came out under. Also, we're looking forward to the changes that will happen in the future with revenue recognition. The FASB and the IASB have a revenue recognition project. They issued a white paper last summer. Comment period closed in October, and they're now refining that exposure draft based on the comments that have been coming in. So let's take a look at SaaS accounting. The big question to answer in SaaS accounting is whether the transaction is software or whether it's a service, because we're going to have different accounting depending on which category we fall into. So we consider it to be software if the customer takes possession. So the customer takes possession on their server, it's delivered to them either typically electronically, or they have the right to take possession from the vendor without significant costs. And this is an important qualifier there, significant costs, even if the customer has the right to take the software, take possession of the software. If, for example, they were on a 3-year subscription service and they'd have to still pay the balance of that subscription and they were in year 1, there'd be a 2-year penalty for that. That would probably be considered a significant cost, and so we wouldn't consider that a software transaction. That would be a service transaction. The customer has to have the ability to use the software independent of the vendor, whether they do that initially or whether the vendor hosts the software for them. It can be a perpetual license or a term license with the right of use over a specific period of time. You typically see license fees and support fees. Upgrades are either part of maintenance or a paid upgrade, and the data typically resides at the customer when they load it on their server or maybe use an independent third party to host it. When is it a service? SaaS software as a service is a service if it's hosted by the vendor. You're typically going to see monthly or usage type fees. The data is going to reside on the vendor's server. The data transition or conversion rights are provided for at the end of use, so if the customer terminates their SaaS relationship, they can obtain their data or convert it to another system. SaaS, when it's a service, is a right to use only, and often there's a significant additional cost to take possession if there is a right to take possession. So that's the primary consideration we take at the upfront of a transaction that we're trying to account for. We need to determine whether it's software or a service. And I think this would be a good time to do our second polling question before we move forward. So if you could read that to us, Caprice, and open the polls.
Okay, the polls are open now. The question is, has your company implemented EITF 081, the relative selling price method for SaaS transactions? And the options are yes, no, in process, and not applicable. So we are getting votes coming in pretty quickly on this one. And it's looking, let's see, we've got over 30% yes, about 26% no, 24% in process, and 18% not applicable, up to 33% yes.
So the majority of the companies between yes and in process are addressing the implementation of EITF 08-1.
Yes, I'll go ahead and close the polls now. It looks like we've got 91% in.
Okay, and then so now, and after we determine what type of accounting we're going to do, whether it's going to be software or service, then we apply the different revenue recognition models for those two different types of transactions. For software, we're going to use SOP 97.2 software accounting. We're going to need VSOE for our undelivered elements, and we're typically going to recognize license revenue on delivery when we have VSOE for support of the other elements, and support would be recognized over the support period. If it's a service and we've got multiple elements, we're going to use EITF 08-1 accounting. Generally, we're going to have a service type transaction is going to be ratable over the subscription period. The accounting for multiple element arrangements, whether they're software or SaaS or service, there's a two-step process we need to go through. That's where we separate out into the different elements, or maybe we determine that we only have one element, and then allocate the revenue to those different elements. And there's a slight difference between the approach on both software and service to both of these steps in our revenue recognition process. So we separate out the elements. Individual elements are elements that are independent, and they are independent if functionally one's not essential to the other, if contractually the payments aren't linked or contingent, and there's no related refunds or rights of return on a delivered item if an undelivered item wasn't provided. Individual elements have standalone value if they're sold separately by a vendor, another vendor. This is the new EITF 08-1 definition of standalone value, and if they have a resale value. Now, if we can't separate out the elements into of the transaction into separate elements based on these criteria, then we just have one unit of accounting, and we treat it accordingly. Again, with different revenue recognition principles based on whether it's a software transaction or a service transaction. And we're going to allocate the revenue to those different elements. Again, software revenue recognition uses the residual method, and service revenue recognition is going to use, now in 2011, we're going to use EITF 08-1, the relative selling price method. If we're in software, we're going to defer the full value of undelivered elements using vendor-specific objective evidence, and we must have that for an undelivered element in order to recognize revenue for the delivered elements. And then whatever's left over, we're going to allocate that remaining value, or the residual, to the delivered elements. So that's where the residual method name comes up. Again, if we've got a a simple transaction with a software license that's delivered and support and maintenance that's provided over a 1-year period. If we have BSOE for the support and maintenance, we'd recognize that ratably over the 12 months of the year, and we would recognize the balance of the transaction after subtracting the support at VSOE on the delivery of the software license. The relative selling price method differs because we allocate revenue to each element based on the percentage of that element of the total value of the transaction. It also differs because we have to have value for each element in the transaction. If we have VSOE, we use that, or we can use third-party evidence, which would be what another vendor sells the item for. Absent those two types of values, we're going to have to come up with an estimated selling price, or ESP, for the other elements in the arrangement. And this is causing a lot of difficulty for companies, particularly when they're used to the residual method, where they could back into the value of any delivered element based on what the value of the undelivered elements were. Here, every element needs to have a value. We're going to defer the revenue for the undelivered elements based on their value of either their relative value, and then we're going to recognize revenue for the delivered elements. We're going to take a look at some specific examples of these two methods so you can see how they work with numbers and examples of different situations. When we have a SaaS arrangement that has multiple elements, typically what we would see is our ongoing subscription fees or monthly or annual fees. There might be initiation or setup fees. A vendor might provide consulting services, both on work process and business optimization, as well as training how to use the SaaS service. And also there might be usage fees, either based separate from the subscription fee on the number of users, the number of transactions processed, or the time that transactions were being transacted. So in SaaS, if we've got more than one element, there's a big question we have to ask, is there standalone value? Often in SaaS transactions, there isn't standalone value. Everything that's separately priced on the invoice in the sales transaction really relates to one thing, the providing of the service over time. But we do have this criteria from 08-1 that standalone value includes items that are sold separately by another vendor. So we may, in situations now, have another opportunity to have standalone value for a customer based on the fact that a service or an item is sold by another vendor. If we have upfront services or setup fees in the SaaS arrangement, typically those upfront fees are a necessary and inseparable part of obtaining the services on an ongoing basis, so they can't be considered a standalone item. A customer wouldn't buy them separately without the service, and they would have little or no value to the customer without the ongoing services. And typically in a SaaS arrangement, a vendor is the only one who provides those upfront setup fees because they relate to the software that's provided over the internet, and is not an item that a vendor is going to open up to a third party to get inside the firewall and provide those services. Revenue from upfront services should be accounted for over the initial contract period. So if you've got a 1-year contractual period, it would go over that period. Or if the expected customer relationship is a greater period, then you'd use that period. So maybe you have an estimated customer life of 3 years, and you take those upfront fees over the 3-year expected customer relation period. For early adopters of the SaaS model and startups, this is sometimes a difficult estimate to come up with it, but it's one that you need to do, and it will probably evolve and change over the time as the company, as the vendor matures and has longer customer relationship periods, and has more information with which to make that estimate of what the relationship period is. Any costs that are related to the upfront fees, we're going to need to determine how we want to account for those, whether we're going to expense them incurred or if we're going to defer them and charge them into expense over the revenue period. In order for a cost to be deferred or capitalized, it needs to be incremental and directly related to the upfront services and to this specific customer. And if it is, we have an accounting option here to either expense as incurred or to defer and charge to expense proportionally over the same period as the related revenue. It's an option that the vendor has, but it needs to be applied consistently, and disclosure is required in the revenue recognition policies that this is the methodology that you're using. One thing we want to mention about incremental and direct cost is if it's a cost that would, like an administrative cost within the vendor or a cost of a service that's going to be present regardless of whether the customer's there, so a dedicated group of people that are not assigned to a specific customer but provide a general service within the SaaS arrangement, that's probably not going to be considered incremental or directly related to this particular customer. So one other thing we need to look at is whether we have one contract or multiple contracts. And we use the TPA 39 criteria to evaluate whether contracts are independent or related. So if we sign multiple contracts with a customer, we need to determine whether we're going to account for those separately as individual contracts or if we're going to consider them one arrangement. And here's some of the considerations that we take into account, some of the factors. We have multiple transactions with a customer. If it's within a short period, it can be considered one contract for accounting purposes. And therefore, if an element lacks VSOE or we're going to have to come up with ESP for all of the elements. We look at whether all the related contracts are completed and signed in the accounting period. So if we've got linked or related contracts and one signed in one accounting period and one signed in another accounting period, we probably wouldn't meet the requirement that the evidence of the arrangement was complete. And this particularly happens with services or SALs that are referenced or being negotiated but aren't complete at the time of the close of the accounting period. And as we mentioned, all the related contracts must be executed in the same accounting period in order for us to have complete evidence of arrangement and to be able to account for them. So some of the factors that we'd look at are whether the contracts or agreement are negotiated within a short time frame of each other, whether they were executed between the same person on both the customer and the vendor side, whether there's different elements that are closely related or independent or interdependent, whether the fee for one or more of the contracts or elements is related to performance of another contract, whether one or more elements in one contract are essential to the other one, whether the payments of the different contracts coincide or are dependent upon performance contracts or another, and whether negotiations are conducted jointly with two or more parts of the customer organization for what is really one project. So those are all the TPA considerations. If we look at them, then we'll determine whether we have one contract or multiple contracts. I think we'll move into our third polling question now. If you could read that, please, Caprice, and then we'll open the polls for the answers.
Okay. What difficulties did your company encounter when implementing EITF 081? The first option, and this, I believe you can pick multiple options here if that's the case. Separation of elements, allocation of revenue to elements, determining ESP, other and not applicable. And early results, determining ESP is well ahead at 42%. 26% or so for allocation of revenue to elements, 22% for separation of elements, and the others are other or not applicable. Actually, quite a few are not applicable. So we're at 90% at this point. I'll go ahead and close the polls and turn it back over to you, Jeffrey.
Thank you. So when we look at, there's other elements that we might have in an arrangement. That would be usage fees, and typically we're going to recognize the revenue for those usage fees when the usage occurs, similar to the way we would look at a metered approach like with your electric bill. So let's take a look at a few examples. The first we're going to look at is the old accounting under 0021, similar to the software revenue recognition model. In this case, the vendor sells an online service. There's a $12,000 one-year contract, so it's $1,000 a month over a one-year period. It's renewable in year 2 for $1,000, and there's $5,000 in setup fees. And we have an expected customer life of 3 years. So in this case, using the old residual-based method using VSOE, which is no longer applicable, but this is the methodology that most companies were using and are used to, we'd recognize the $1,000 monthly service fee over the 12 months, and we take that $5,000 setup fee when it's delivered. We've delivered that and the service starts. We'd recognize that ratably over the 36-month period, so we'd be recognizing $1,000 monthly for the service fee and recognizing $130 monthly for the setup fees. So you see the way the revenue works using the residual model, and notice that those setup fees are going over the expected life, how they market and price their products, whether they want to have high setup fees, which are going over potentially longer periods, or having more of an all-in a fee approach. Example 2, with the same set of facts, but now using the new accounting from EITF 08-1, the relative selling price method. We look at the $12,000 service fee, the $1,000 monthly. We have VSOE that because there's a renewal a rate for that. And we've got the $5,000 in setup fees, which have been delivered. We're going to use the relative selling price method. So we'll use VSOE for the monthly service fee. We're going to have to come up with a value for the setup fees. And in this case, we're going to have to use ESP, or our best, our estimated selling price, and then calculate the relative selling prices of each of the items in the transaction, the $17,000 transaction. So we'd see that we have $12,000 VSOE for the service fees, and we have $8,000 estimated setup fees. We discounted those in the deal. They have relative value of $20,000 total, so that the service fees are going to have a 60% relative selling price, and the setup fees are going to have 40%. We'll apply that to the $17,000 total arrangement fee, and we'll get $10,200 allocated to the service fees, $6,800 to the setup fees, and you see that the revenue is slightly different based on the relative selling price method when compared to the residual method. We'll take a comparison here. So in year 1, under the residual method, we would have recognized $13,700 basically, and using the relative selling price method, we're using $12,500 because of the differences between the two methods. Here's example 3. We have a vendor selling an online service. We've got again, a $12,000 annual contract. It's renewable in year 2 for $12,000. We've got $10,000 in training at $2,000 a day, which is also VSOE. So we've got a total transaction fee of $22,000. And the question we're going to need to ask is, does the training have separate value from the monthly service fee? And there's could be a variety of opinions on this somewhat subjective area, but it could definitely have separate value, particularly if similar training is sold by another vendor. We would get to standalone value and therefore account for them as separate elements. In this case, both the elements have VSOE, so we're going to account for them at their contractual amounts, the $1,000 monthly service fee. We recognize that ratably over the year, and we defer the balance of that and recognize it monthly. The training we'd recognize when it was completed, assuming that the training has a standalone value. And in this case, there wouldn't be any difference between the two methods because both elements have VSOE. If there was any discount present in the deal, then obviously the relative selling price between the two elements would change when the revenue was allocated. And now we're going to look at example 4. If we have customization services, if we've got a large cloud application with a $100,000 subscription fee for each year, it's renewable in year 2 for $100,000, so we do have VSOE. And we have $50,000 in customization services that are provided. We're going to ask, do the customization services have standalone value? I think typically we're going to find that they don't, particularly if they are not offered by another vendor. And in that case, we're going to take a look at them, but typically customization services have no standalone value because the customer only gets value from the services when they use the subscription services. Therefore, the hosted services and the customization would be treated as one single element, and we just take the total transaction fee and recognize that ratably over the subscription period. We could capitalize and expense the customization costs depending on our company policy election and whether we could adequately identify and capture them as incremental and direct costs for the customization. And now we're going to have our final polling question and take any questions that might have come up during the course of the transaction. So, Caprice, if you could bring up our final polling question.
Okay, final polling question is, will you be evaluating revenue management software for your company in the next 3 months, the next 6 months, next 12 months, next 24 months, or not applicable? And we'll wait till this gets up to about 90%. Okay, looks like we've got most people in. Jeffrey, I'll go ahead and close the polls.
Okay.
And turn it back over.
I want to take a look at some of the questions. One of them is about CPE credit. So if you've answered the questions during the webcast and have let us know that you want CPE credit, we will send that out to you. The slides will be available on the Tensoft Resource Center starting tomorrow, I believe. And if you have any questions about any of those things, you can also email us. Here's a question relating to professional services. How long should professional services fees for initial implementation be recognized for SaaS contracts? Well, as we discussed, if we have implementation or setup fees, we're going to look at whether the estimated life of the customer and take them over that if it's longer than our initial contract period. So if we have a 1-year contract but we have a 3-year estimated customer life, then we'd be taking them over that 3-year customer life. If the longer of contract or customer life, what do you do in the case when the customer life has been valued at 20 years in purchase accounting? Typically, deferred revenues wouldn't come over if you've done a purchase accounting. Most of those deferrals become part of the price in purchase price allocation and don't enter revenue after the purchase. So I have a question. If we have a subscription model but we allow the customer to install at their site on their server, what would be the best way to evaluate this transaction? Well, that would appear to me to be a transaction where the customer is taking possession of the software. It would depend on the licensing arrangement, but if they had a license to that software independent from the vendor, I would believe that if they took possession of the software, even if it was for a term period, that we would be under software accounting and not under services or SaaS type of accounting. Here's a good question that relates to whether the fee is fixed and determinable. What if the contract is structured in a way where we don't know the total value of our arrangement? Does that mean we can't recognize revenue for delivered element, even if the undelivered elements have an estimated selling price? Well, we would allocate revenue to the individual elements of the arrangement if it was a SaaS type arrangement using the relative selling price, but we would only allocate the known or determinable amount of revenue. So to the extent that some of that revenue was contingent or uncertain, we wouldn't recognize that until the contingency was resolved or the amount of the revenue became fixed and determinable or certain. Okay, here's another question about the estimated customer relationship. So if you have customers that have been software license customers of you for a long period of time and you move into a SaaS model, I don't think necessarily you'd look at what their software license relationship period was, because particularly if they're perpetual license, that would be forever. You'd look at what you expect your software as a service or your cloud customer life to be. And you'd probably expect a little more churn than in a perpetual license customer, because a perpetual license customer has that upfront large investment that they want to recover over time, whereas SaaS or cloud customer is paying on a monthly basis, so they've got a lower exit cost in the sense that they can just fire up another SaaS solution. So there's a question about what do we do if we don't have VSOE for the subscription? Well, if we're using the estimated selling price methodology, we need to apply value to each element. If we don't have VSOE, then we're going to look to see whether there's a third-party evidence of value. If there's a customer that sells an identical service or product, we would use that. If not, we would need to come up with an estimated selling price, and there's a number of methodologies that companies use to come up with that, whether it's a VSOE light approach where maybe you didn't meet the VSOE requirements to have 85% of your transactions within plus or minus 10%. Maybe you're down more in the, say, 60 or 70% and plus or minus 20. That might be a good methodology. You could use cost markup type of approach, and also you can use average discount. If you've got different products or services that have consistent pricing, you could use those. What is your opinion on why the relative selling price method is better than what was used before? Well, I don't know that it's better in all cases. For hardware type companies, it's definitely perceived as being better because they had a lot of upfront costs that were being expensed and the revenue was going over time, and the residual method didn't seem to be capturing the essence of the economics of the transaction. I think what a lot of people are finding is that creating and using ESP for every element of a transaction is much more complicated and resource intensive than maybe it was anticipated. And since you can't back into transactions like you used to be able to do with the residual method, where you only had to have VSOE or value for the undelivered elements, now that you have to have value for all the elements, that's a much more wide-ranging situation. Also, it's a more technology-intensive relation, And a lot of companies' current ERP systems and accounting systems don't have the ability to use estimated selling price or the relative selling price method. So that's another thing that companies need to do. They need to come up with systems to do that, and that's one thing that Tensoft can work with you to help provide. So we're just about out of time today. I want to thank everyone for attending. Again, we'll capture the questions, and if there's specific questions that you had that were not answered, I'll try to send you a response, and we'll get those up on the blog in the next couple of days. Just some resources that you might look to for additional information: Big Four revenue recognition guides and white papers. All four of the big firms have websites with a variety of resources there. The IACPA, the FASB, and the EITF you can get their pronouncements and use them for your guidance. There's SEC filings if you're looking for how companies disclose their transactions. And there's webcasts such as this one and the upcoming webcast that we'll be doing in May on software revenue recognition, and also just web searches of your topic and your issue. If you have further questions or comments, or if you're interested in revenue recognition consulting, I can be reached at wernerj@sbcglobal.net. And once again, we do have the software revenue recognition webcast coming up on Thursday, May the 19th, part 1. It's 9 a.m. to 12:30. And Wednesday, May 25th, part 2, 9 a.m. to 12:30. Again, there is CPE credit for that. It's paid per attendance, and the registration and details will be available soon. By attending this webcast, you're most likely in our email database, and we'll be receiving an email about that. Or you can also check back to the Tensoft Resource Center in the next few weeks. Again, we'll be covering general principles of revenue recognition, multiple element transactions, VSOE, license support and services issues, and we'll look at service and contract accounting, software as a service, implementation of the new EITFs, and discussion about where the FASB is going with its revenue recognition project. So that concludes our webcast today. Thank you very much for joining us, and hope you'll be back with us at our next webcast, and stay tuned for future webcasts. So thanks for joining us today. Take care.